Welcome. As a follow-up to the video we did 2 weeks ago talking about required minimum distributions, let's today talk about Medicare planning. One of the biggest Medicare surprises that catches people off guard is IRMAA. This is an extra charge added to Medicare premiums, which kicks in if you earn more than $109,000 as an individual or $218,000 as a couple filing jointly. These amounts are for coverage year 2026 and are adjusted annually. IRMAA stands for Income-Related Monthly Adjustment Amount, and it affects Medicare Part B and Part D premiums. And unlike the marginal tax brackets that many taxpayers are used to, where only the income above each threshold is taxed at a higher rate, IRMAA operates as a cliff. This means that if your income exceeds a threshold, even by $1, you pay the full surcharge for that entire bracket. What makes this even trickier is that IRMAA is applied each year based on your modified adjusted gross income from 2 years prior, since that would be the last filing that the IRS has available. So for instance, the surcharge you face at age 65 is determined by your income in the calendar year that you turned 63. This 2-year look back means that financial decisions made years before Medicare enrollment, such as Roth conversions, capital gains realizations, or even the timing of Social Security benefits, can have significant consequences. It's also important to understand that the income thresholds for the IRMAA calculation differ from the IRS marginal tax bracket thresholds. So a common strategy in retirement planning is to fill up a tax bracket by recognizing additional income. However, doing so without considering IRMAA thresholds can inadvertently push you over an income cliff that results in thousands of dollars of additional premiums. There are several strategies that can help manage this IRMAA exposure. Qualified charitable distributions, for example, allow retirees to direct required minimum distributions to charity without increasing their adjusted gross income. Timing partial Roth conversions at least 2 years before Medicare enrollment can also help. Delaying Social Security is another consideration, but this one cuts both ways. While it reduces current income and can help avoid the IRMAA threshold in the near term, the higher premiums that result from delaying could coincide with required minimum distributions later, potentially pushing income above surcharge levels in the future. These trade-offs are among the reasons why wealth management in retirement requires a coordinated multi-year approach. And there are a few additional considerations to keep in mind as we plan for this increase in healthcare spending as we age. First is that timing is critical. Missing the initial enrollment period, which is a 7-month window centered around your 65th birthday, can result in a permanent 10% penalty on Part B premiums for each year delayed unless you qualify for a special enrollment period through active employment. Secondly, limited long-term care coverage. Medicare provides only a long-term care support under specific circumstances, such as a qualifying hospital stay and admission to a Medicare-approved skilled nursing facility for a condition expected to improve. This is not a replacement for long-term care insurance. Thirdly, life events can impact costs. Major life changes such as job loss, divorce, the death of a spouse can trigger a reassessment of your IRMAA surcharge, potentially lowering premiums if your income declines. The key to Medicare planning is working with a partner to make sure you understand the complexities and how they will affect you ahead of time. Thanks for watching. Enjoy today.